Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is securitization, what to expect in 2025. My name is Tameem Zainulbhai, and I'm a partner in Mayor Brown's Chicago office and a member of the banking and finance practice. Joining me today are my fellow Mayor Brown partners, Janice Kong, Patrick Healy, and Frank Doorley. Janice is a member of banking and finance practice in New York. Patrick is a member of the banking and finance practice in Chicago. Frank is a member of the financial services practice based in our Washington, D.C. office. With that said, let's begin. I'm going to be talking about residential mortgage loans and the residential mortgage loan market. Looking back on 2024, volumes and issuances are up versus 23, especially in the non-QM market. There are a lot of emerging opportunities in traditional home equity products and newer home equity products, such as home equity option contracts, home equity investment contracts, card-linked HELOCs. There's also continued growth in the residential transition loans and DSCR lending. Speaking of residential transition loans, those are also known as fix and flips. They are business purpose mortgage loans for the purpose of real estate investors to purchase and renovate residential or small commercial properties. Borrowers are typically experienced home flippers or professional real estate developers. The market for securitizations of RTLs grew rapidly in 24 after the issuance of the first rated transaction in February of 2024. As of the end of 2024, 6 platforms had issued rated RTL securitizations. Unrated deals continue to be issued, especially for products that receive less favorable treatment from rating agencies. So what can we look forward to in 2025? Well, it's expected that the issuance of RTL securitizations will again increase, and the gross issuance of those securitizations is predicted to increase to $11 billion. The demand for RTLs is largely driven by a tight housing supply and aging housing stock. Innovative tax structuring has allowed for a revolving REMIC structure. This provides maximum flexibility for the capital structure and trigger events, but does prevent upfront and ongoing costs. Let's take a look at home equity investments. This is a product that allows a homeowner the ability to grant a third party an interest in the homeowner's property in exchange for an upfront payment. It can be structured as an option to acquire a percentage of the appreciation in a residential property or a forward sale of an ownership interest in the property. The contract holder's rights under the home equity option contract are typically secured by a mortgage or deed of trust. As continued home price strength means homeowners have an unprecedented amount of untapped equity. Even with Fed cuts, because interest rates remain high versus long-term averages, making debt options less attractive and discouraging homeowners from selling, home equity option contracts are increasingly attractive. Recent rated securitizations provide a reliable takeout option for originators and contract owners. Rated structures also make it possible for insurance companies to provide leverage for HEI acquisitions. Taking a quick look at single-family rental and iBuying, SFR as an asset class is proving durable even when facing headwinds from high interest rates that compress DSCR and force down advance rates. There continues to be solid rental demand and rent growth. Issuers are opportunistically selling homes in order to capture home price appreciation gains and relieve DSCR pressure. Move to community financing, especially build-to-rent and partnerships with home builders, where costs and service delivery are easier to manage than dispersed pools of homes, is becoming more and more popular. Let's take a quick look at digital mortgage assets. This is a booming area, even in advance of adoption of the new UCC Article 12, which allows for security interests in quote-unquote controllable electronic records. There's widespread applicability of this technology. It applies to both traditional mortgage loans and for second lien products. There's a broad vendor base at all stages of the production flow and strong consumer familiarity. And there's ample opportunity for investment and innovation in the market, including blockchain applications. Originators find digital mortgage assets are easier to scale, have lower costs to originate, and require less manual processing. Warehouse lenders and securitization market participants appreciate the robust statutory basis for these assets, as well as straightforward perfection and granular asset detail. Turning to MSRs, we have seen and continue to see a proliferation of funds and other investment structures in order to get access to the MSRs. The Ginnie Mae risk-based capital rules remain top of mind, and the effect was delayed through the end of 2024, but there continues to be uncertainty regarding actual application. We've also seen a proliferation of master trust financing structures, which is a technology that allows multiple different lenders across a singular pool of agency MSRs. In the reverse loan space, we are looking forward to the implementation of HMBS 2.0. And we also have seen and will continue to see REMIC structuring innovations for non-performing reverse mortgage loans. Historically, these non-performing loans would be excluded from REMIC transactions, or if included, would be repurchased out of the transaction prior to becoming an REO property. Our innovative REMIC structuring includes a REMIC accommodation loan that functions as a revolving installment loan, allowing non-performing loans to be included in the transaction and to remain in the transaction even after foreclosure has occurred. And with that, I pass it over. Thank you, everybody.
I'm Janice Kong, and I'll be covering structured finance transactions in the fintech space. We handle warehouses, ABS term deals, both public and private, and forward flow whole loan sales involving fintech assets such as unsecured consumer loans, resi solar, buy now, pay later, small business loans, and various consumer loans. Deals in the fintech space were strong in 2024 and are continuing strong so far in 2025. One trend that we've been seeing in the fintech space is that participation from private credit has been growing. We're seeing more hedge funds and asset managers in addition to the usual big investment banks that we typically see. In the past, we've typically seen asset managers in forward flow transactions purchasing pools of loans directly from a fintech company, sometimes with leverage from a bank. We previously haven't seen them doing much else in this space. However, we are now seeing greater participation from asset managers and hedge funds in warehouses and ABS transactions. For example, in a normal course 144A deal, we've seen asset managers come in and take an entire tranche of notes through a direct 482 private placement. Since this is through 482, this allows them to make specific comments and negotiate for certain terms in the documents. So instead of selling the notes to the initial purchasers first, these notes are effectively retained and then sold through a direct placement to the asset manager or the funds that they manage. Separately, in asset-backed warehouse facilities, we're also increasingly seeing asset managers acting as agent and lenders. So instead of the asset manager acting as an administrative agent, there could be a third-party agent, but the agent will take all directions from the majority lenders, and the lenders or funds or other entities are managed by the asset manager. So effectively, the asset manager has control over all the lender decisions, even though the admin agent is a third party. We're also seeing warehouses with multiple tranches where the asset manager provides a subordinate tranche at higher advance rates than the senior piece, which is typically provided by another bank. We're also seeing more residual transactions where the asset manager is actually providing a loan backed by the residual pieces of existing warehouse facilities rather than directly backed by the receivables themselves in the underlying transactions. One of the reasons for this growth in private credit is market volatility, especially in the fintech space. I'm sure people have all seen the bad press on resi solar over the last year, and the CFPB also released a report in August identifying consumer regulatory risk in the solar financing industry. While this was specifically related to resi solar, there has also been increased attention and scrutiny on other fintech asset classes as well. And as a result, we did see a slight downturn in the market generally in the fintech space. We saw some issuers pulling away from the market completely or doing fewer deals. Issuers also had more trouble selling their sub bonds and their residual certificates. Some weren't able to find buyers at all, or they received very unfavorable pricing. Generally, there has been increased scrutiny on whether companies are complying with regulations around licensing, usury and fee restrictions, marketing practices, disclosure rules, and related consumer laws and regulations. Given this increased attention on regulatory concerns, there has been a focus on building in certain deal protections in our transactions to mitigate these risks. Recently, Mayor Brown has been getting asked to do a very robust regulatory diligence review and now more frequently providing regulatory memos. This is a big expense for the deal, so we haven't really been asked to do this in the past, but it's becoming more and more frequent. This could involve doing a deep dive into the program agreements, customer agreements, any marketing materials, and any disclosures that are provided to the customers or the obligors. And this may also include a review of important third parties, such as subservicers, installers, at least in the Resi Solar context, and any other significant third parties. We're also seeing additional reps and warranties getting added on topics like general compliance with law, licensing, information security and privacy matters, etc. You can also add state-specific eligibility reps to address these regulatory concerns. So, for example, with respect to usury laws in certain states, eligibility reps can ensure compliance with specific usury restrictions that are lower in certain states, or if there are particular gray areas. Similarly, lenders are focusing more on concentration limits. State concentration limits are a good way to limit your exposure to riskier states in the regulatory context. Other protections we're seeing are indemnification rights for regulatory events and additional audit rights and increased reporting to help you identify issues or potential issues sooner rather than later. And we're also adding in covenants to provide notice of new investigations, litigation, or other regulatory events. It's also becoming a common request to add regulatory triggers, which would trigger an event of default or an early amortization event. In the whole loan sale context, a regulatory trigger could trigger termination rights or just a stop funding event to give the purchaser the right to suspend loan purchases for a period of time or until the event is cured. And lastly, something that we really haven't seen before, but rating agencies are also now taking more of a deep dive into regulatory issues and also performing their own diligence. So with this increased regulatory scrutiny, there are a number of ways to mitigate these risks. And that's it from me on fintech, and I'll pass this along to Patrick.
Thanks, Janice. My name's Pat Healy. I'm a partner in the Chicago office. I focus pretty much exclusively on trade assets, including trade receivables, trade payables, and inventory deals. So the first thing that I wanted to talk about was certain accounting developments that we've seen over the last year. The first has been that there have been some signs that the European Central Bank has been scrutinizing credit risk reporting with respect to banks' factoring / receivables purchase exposures. While it's not entirely clear to us what this stems from, it seems likely that in part this is at least in part from the continued hybridization of receivables factoring and securitization structures. We've definitely seen a lot of sort of movement in that space to add features that are more common in one type of transaction to the other. And because of that, there's probably a bit of confusion and also concern on the part of regulators that these product types are being sort of blurred a bit. So I think we can definitely expect to see some movement on this issue in the coming year and hopefully hear some guidance on that. We've also, as we have over the last few years, seen some sustained focus on traditional payables and supply chain finance programs. Particularly, people are concerned about whether or not these constitute trade payables as opposed to short-term debt for balance sheet purposes. When the recent accounting guidance was provided the last year or so, people had thought it would resolve a lot of these issues, and apparently that hasn't been the case. And so we've definitely seen a lot of concern in the market about this. I think most participants in the market have viewed and still do view the traditional trade payables / supply chain finance programs as a legitimate product, but there have been a fair number of transactions that have concerned the accountants and investors. Just one particular example from a recent Bloomberg write-up is that BYD, a Chinese manufacturer of electric vehicles, was recently flagged for potentially disguising debt via the use of supply chain finance programs. This is one in a number of sort of high profile cases that we've seen in the last few years. And we expect this scrutiny to continue as companies push the envelope in structuring their supply chain finance programs. Another interesting development is that we've seen some accounting firms take a sort of an alternate view on the application of ASC 230 to factoring programs. So, just for some background, for anyone in the trade AR securitization space, you're already going to be aware of this issue. It came up a few years ago when the accounting firms took the position that the quote deferred purchase price component of the purchase price for receivables under a securitization should be characterized as income from investment activities as opposed to income from operating activities. Companies and their investors tend to view this less favorably than the other way around. Therefore, over the last few years, there have been a bunch of deals structured, trade securitization deals, structured with a recourse pool mechanic, which avoids that characterization of cash flows. It's only been in the last year or so that we've seen some accounting firms take the position that the DPP in a factoring deal should be characterized as income from investment activities. In the few deals that we documented with this issue, we switched from for example, 5% DPP feature to a 5% recourse piece. In other words, the cash is paid up front with the opportunity for a clawback as opposed to holding back a piece of the purchase price initially. Of course, this increases seller risk. So for example, one of the deals that we did, the recourse obligation was backed up by a letter of credit. It's hard to say at this point whether this is a trend that is going to continue or whether this is just a sort of a couple of one-off, very particular fact-specific deals. I suppose we'll see, and to the extent that this does become sort of a widespread issue, we'd expect, a lot of these deals to sort of be, relooked at for this particular issue. The next topic is one that's been very hot over the last few years: inventory monetization, specifically off-balance sheet transactions. People have been talking about it for a while. It's definitely been one of sort of the most common questions that we get from clients is how to structure these deals. It's taken a while to sort of figure out the best way to do this, and some of it has been trial by fire, but we've definitely seen an uptick in actual deals as opposed to just theoretical interest. We had some major transactions, for example, over $1 billion transactions in both 2023 and 2024. We also have multiple transactions in process for large companies as well, and we expect this to increase significantly in the future as people become more and more comfortable with this product. We've definitely seen sort of increased visibility among corporates. In particular, the industry sectors that we've seen the most interest from tend to be tech, auto, and commodities. So, as we have over the last few years, we expect this to increase more and more in popularity and hopefully see, some pretty solid deal flows in this particular sector. So with that, I will hand it off to Frank.
Frank Doorley, a partner in the banking and finance practice in Washington, D.C. I focus my practice on regulatory compliance issues in the consumer and small business credit asset classes, and I'll briefly discuss the regulatory outlook for the year 2025. With the new presidential administration taking office in January, there is the potential for significant changes in the approach of federal financial services regulators, particularly the Consumer Financial Protection Bureau, or CFPB. Under the Biden administration, the CFPB aggressively grew and expanded, particularly in its supervision and enforcement functions, and asserted broad jurisdiction over novel financial products and services. Under a Trump administration, we already have seen and are likely to see significant changes to the CFPB and its regulatory approach. First and foremost is the leadership turnover. The existing CFPB director, Rohit Chopra, was fired by the Trump administration on February 1st. Treasury Secretary Scott Bessent is now the acting director of the CFPB, although it's not clear who the Trump administration will eventually nominate as a permanent replacement for Director Chopra. Whoever the new CFPB director will be, there is a good chance that the new director is not going to share Director Chopra's priorities and vision for the CFPB. It's worth noting that Secretary Bessent stated that he looks forward to lowering costs for the American people and accelerating economic growth as acting CFPB director, a noted departure from Director Chopra's stated priorities for the CFPB during his tenure. And according to news reports on February 3rd, Secretary Bessent has already put a hold on any CFPB rulemaking activities that are not required by law. Second, the Biden CFPB had been pursuing various expansions of its supervisory authority and information gathering for enforcement purposes, including its larger participant rule for digital wallets, efforts to issue a proposed larger participant rule for personal lenders that would result in many personal lenders becoming subject to supervision by the CFPB, and also its so-called quote unquote repeat offender registry. In 2023 and 2024, the CFPB increasingly sought supervisory authority over non-banks that, in the CFPB's view, posed risks to consumers. A Trump administration CFPB may reconsider or shelve at least some of these efforts. Next, the Biden administration CFPB often sought to regulate financial services providers through non-traditional, informal means outside of formal notice and comment rulemaking processes. The CFPB made extensive use of advisory opinions, informal interpretive rules, policy statements, industry circulars, and amicus briefs in private litigation where the CFPB was not a party to announce positions or advance aggressive interpretations of federal law. We would expect the Trump administration to pull back on the use of these informal policy-making methods. Finally, the existing rules issued under the Biden administration CFPB may be subject to increased challenges in light of the Supreme Court's 2024 decisions in the Loper Bright and Corner Post cases. Loper Bright replaced the Chevron test, which had required courts to defer to an agency's reasonable interpretation of a statute when that statute was ambiguous, and replaces it with a best interpretation standard. The Corner Post case interprets the 6-year statute of limitations for challenges to rulemakings to run from the date a specific plaintiff could have been affected by the rule, rather than the date the rule was issued. Each of these could have the effect of subjecting even long-standing CFPB rules to potential litigation and to potential overturning of the rules. That said, even if there is a pullback at the CFPB, state financial regulators and attorneys general may step in to fill this void. State attorneys general have the authority to enforce provisions of the federal Dodd-Frank Act and regulations issued under the Dodd-Frank Act, and this can provide a basis for aggressive states to continue historic CFPB priorities. In addition, states are authorized to enforce their own laws, including those that require compliance with federal laws or that impose materially similar standards. And several states, such as Maryland and California, have actually enacted laws that authorize their financial services regulator to become a sort of mini CFPB at the state level. State legislatures and financial regulators have also sought to enact new statutes or to expand their interpretation of existing laws to capture additional market participants or new products, such as by enacting so-called true lender laws to capture bank partnership lending programs and sweep these programs and the loans originated through them into state licensing and regulatory regimes, or by broadening existing state licensing laws to cover substantive pre-origination activities or the acquisitions of loans or interests therein, as well as enacting laws to specifically license and regulate novel products such as earned wage access, home equity investment or shared appreciation products, and also to previously lower regulated products like small business finance. We expect that these trends will continue in 2025. Last, there's also the possibility that federal and state regulators may attempt to assert jurisdiction over securitization entities or to hold such entities liable for violations committed by third parties. In 2024, a three-judge panel of the United States Court of Appeals for the Third Circuit had held that the National Collegiate Student Loan Trusts are covered persons under the federal Dodd-Frank Act and are subject to the CFPB's enforcement authority because they engage in providing consumer financial products or services, which in that case were student loan servicing and the collection of debt related to those student loans. The Supreme Court denied a petition for review of this decision in December of 2024. Although the decision is limited to the question of whether those trusts are covered persons for the CFPB's enforcement authority, and an entity isn't liable for a violation of law merely because it is a covered person, that decision has potential implications for the structured finance industry more broadly. First, the court's reasoning could apply to any consumer loan asset classes, not just student loans. And second, the trusts could be held liable for third-party conduct, which has implications for the level of third-party oversight and regulatory due diligence performed in connection with securitizations and on an ongoing basis. Finally, state licensing and enforcement agencies could use the Third Circuit's reasoning to try and extend the reach of their licensing, enforcement, and supervision powers to securitization trusts. And it's more than just a theoretical possibility that states could attempt to insert their licensing laws against securitization vehicles. On January 10, 2025, the Maryland Office of Financial Regulation issued formal guidance asserting that assignees of residential mortgage loans, including certain passive trusts that acquire or obtain assignment of residential mortgage loans in Maryland, must become licensed in Maryland prior to April 10th. The guidance raises significant questions about how Maryland will apply this new licensing requirement, including whether it will be applied to trusts that hold title to assets through a national bank, acting in capacity as trustee for a trust, how assignees of residential mortgage loans will respond to the new guidance, and whether and to what extent this guidance will impact the secondary market for Maryland residential mortgage loans. Although the ultimate resolution of this Maryland issue is unclear and there remain significant unanswered questions, it is possible that other aggressive state regulators may use the Maryland guidance as a roadmap for them to enforce their own licensing laws against securitization entities. With that, I'll hand it back to Tameem for closing remarks.
Thank you, Frank, and thank you all for joining me and all of us on this episode. And thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. That's gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.